Then my question would be like, if China is undervalued, do you think it will go up? So it is undervalued for a real reason, right?
US is the real dragon, the one that keep on flying. You sound smart when you pretend to be a bear lah. I think bear always give people impressions that the person is very smart, is very thoughtful about like market. And then those perma bull, right? People will say that I perma bull clueless one, don't know how to read basic chart.
Welcome back to another episode of the Backholder Pod. So I think we have been receiving a lot of I won't call it hate, but allegations. Bull of the S&P 500, then they pull out the 100-year chart and then tell you that, oh, the stock price or the valuation of the US market only goes one way, which is to go up. And you hold long enough, you'll confirm make money. So the prudent advice is to just close your eyes, set up a regular savings plan, buy hold long term, confirm what, meaning you'll confirm make money in the long term. But I think to have a more nuanced discussion, I think Kelvin has recently also made a video which will extend the discussion here, where saying that buying at the S&P today, after this back-to-back 20% rally from 2023, then into 2024 today, and it seems like the index is going to close again near all-time highs. It does seem, I guess, slightly, you can call it overextended, you can call it overvalued from a fundamental and a technical point of view. So I think I just did a quick search on, there's this site, right, called www.currentmarketvaluations.com. The US market is suggesting that it's overvalued. So just to cite a few numbers, right, to give you guys a bit of appreciation. So the current S&P 500 10-year PE ratio is close to the 2 times standard deviation. Back in the internet bubble times in the 2000, we were around 3 times standard deviation. Quite an elevated level of more than 24, 25 times based on the time of this recording. So that's also another point of view that you point to some of these numbers, whether it's on a PE, PS, Shiller PE. Pass the time over to Kelvin on your thoughts on the current so-called market overvaluation.
When you say overvaluation, that number is based on historical levels, right? If you look at historical levels, a lot of things have improved. For example, technology has improved. Company earnings have improved. The profit margin has improved. Plus now with this whole AI wave, it's going to replace a lot of people. So basically productivity will also improve at the same time. So when everything goes up, do you think that valuation should use back the old level, or do you think the new valuation should be improved as well? So that's my first thing. Because people say, oh, because S&P is overvalued, then it will crash. So on the other hand, then my question would be like, if China is undervalued, do you think it will go up? So it is undervalued for a real reason, right? Because there's a political risk weighing down on this whole valuation. You take off that political risk, I guarantee you tomorrow China will go up, boom, straight away back to S&P level already. But the S&P, the whole productivity earnings increase, that's why it bring this up. So when people ask, oh, when will S&P crash? Guess on our channel, he was this full-time dividend investor guy. I remember asking him, he said, oh, S&P is overvalued now. Then my question to him is like, okay, so when will we crash? Is it by next year, by 2 years, by 3 years time? He's like, oh, okay, I don't know how to answer this question. That was my impression of him. You only look at this PE high equals crash. So I think that's a very, very shallow way of looking at things. So now I'll give you 3 scenarios. So because Goldman Sachs, they predicted the S&P will give 3% over the next 10 years. Scenario 1, Goldman Sachs is correct. What we'll do in this case, S&P crash, basically nothing changed. You just dollar cost average down, keep buying all the way, eventually hope it recovers, because after it crash, it's cheap now. So if cheap equals go up, that's their logic. Cheap equals go up. So you will profit in this case. Scenario 2, it doesn't crash, it continues going up, maybe 10% or even 13% like the past 10 years. Oh, in this case, you will profit also. Third scenario, the entire US economy collapse. This one not only US affected, basically the whole affected. So even you buy China, you will also die. So by the time, probably the thing that will profit is your toilet paper money. Fourth scenario, US enters into a Japan lost decade. 20 years, 30 years, never come out. What we do in this case? You just keep buying. But even if it collapse, right? I think US has their way of doing things, because US is not like Japan. In every scenario, you will profit as long as you hold long term. So is this PE ratio thing an important thing to me? This one, unless you're investing short term, this one definitely you will die. But if you're investing long term, in every scenario you will profit. So it's hard to say I'm not a perma bull. Yeah.
So can I rephrase whatever you just said in the last few minutes, that just close your eyes and buy S&P should be correct?
Short term definitely no lah. Don't buy S&P. If your investing horizon is at least 20 years, 30 years, I personally feel S&P is a good bet. Good bet. It's not 100% guarantee. If you are worried of that, just diversify a bit overseas law. Even if you buy BWRA, I think the allocation to US is also about 60-70%. So there's no way you can avoid US.
So I've been thinking about plowing more money into the US stock market, but honestly, buying into an all-time high market, it might be a little bit terrifying. What if I end up buying at the top and losing money instead?
Oh, I know what you mean. I bought this stock once. Let's just say it's still on Earth.
Guys, you need to check out Momo. Momo has a strategic partnership with Nasdaq to host the global US stock simulation paper trading competition, and is a risk-free way to practice trading or letting you win rewards.
Oh, wait. You're saying that you can practice and win rewards? What kind of rewards are you talking about?
You start with $1 million in virtual funds. It's like Monopoly money, but without your little cousin cheating.
1 million? That's like $999,000 more than I have right now.
And what's the catch? Do I have to trade in my life savings or something?
No, it's totally free, and if you manage to have a positive return every week over 5 weeks, you will win a share of $20,000 rewards each week with other winners.
Wow, 20,000. Not bad. I mean,
Wait, what if I want to aim for the top? Are there any more rewards?
Well, the top 3 winners in your local region get up to $1,000 in stock cash coupons, and if you are among the top 3 globally, you could win up to $10,000. Plus, you'll get featured on the Nasdaq screen in New York Times Square.
What? Then are we famous, right?
yep. So if you register for this competition using our link below, you'll get a 1-month access to Nasdaq Total View market data worth $25.99, valid for 62 days.
That's awesome. Are there any other sign-up rewards for new users to Momo?
New users who sign up with our links will get up to $1,034 worth of welcome rewards. Plus, you will also get 0 commissions for Hong Kong stock trading for 30 days.
Kelvin framed his entire talking point, whereas like those that invest in China hates the US. But I don't know why I feel attacked. But anyway, I can understand people making the case where people that are very, very bullish on China are quite bearish on US and vice versa. So I'll keep my points first. Maybe we'll get Bunti to comment. The most hot one from the US market.
Okay lah, of course, US is the real dragon, the one that keep on flying. I heard this argument quite a fair bit. Now we come back to the topic about valuations, right? And then you just notice that everyone just suddenly become valuation expert. Maybe they themselves never do any analysis, right? And then just pull up some chart and then just describe the market as if it is like they know it is overvalued. So the first caveat I want to make is that definitely, right, it's very hard to justify to say that today's level is cheap. That's not what I'm trying to say. What I'm trying to say is that if you go into the details, right, and try to understand each of these indicators in detail, right, there are some explanations on why it is on the high side. Okay, I give one example. I think the one common one quoted is the Buffett indicator. So you know how Buffett indicator is calculated? So it's taking the total US market cap divided by US GDP. And then this number, right, if you look at over time, right, it's like trending up one. The question is like, how come this is trending up, right? Because you're essentially comparing a total market cap of a country divided by the GDP of that same country. But right, the ratios should be, there should be a level where it should average over time, right? When you look at the total market cap, right, these are, the biggest companies. We are talking about Apple, Amazon, their earnings, right? Most of their earnings actually come from outside of US. I wouldn't say most, it's like huge proportions of their assets coming from outside of US. This is not the case if we just go back to, let's say, 20 years ago. So 20 years ago, you look at US market cap, really their earnings, right, really coming mostly from US domestic. But now because all these companies, because of globalizations, right, actually their earnings quite a significant portions actually came from outside. And then when you look at the US GDP, it only count the GDP inside. So that's why as this percentage of earnings coming from outside of US become larger, right? This ratio will naturally drift upward, man. So that's why if you look at this number, you say that Buffett indicators say that it is expensive, it is as high as historical period. US is overvalued. Actually, you didn't pay attention to all these minor details about each of these indicator. For the other indicators, we can also go into the details, but I just want to give a like a opening to say that actually all these indicator, you thought that you look at the chart, you think that you are you look at the PE, you thought that okay, I'm the expert, I know it is expensive, right? You just haven't looked into the details. I mean, in enough depth on those metrics.
To play devil's advocate, right? I can understand where these commentators are coming from. I think how I understood PE ratio is simply for $1 of earnings today, how much are you willing to pay? Meaning, what's your break-even period? And because we are talking about a major index today, like the S&P, there are good companies, there are bad companies. So there are quality companies that consistently improve their margins, improve their earnings, and you're expecting the earnings to come back a lot more in the future. So that's why I don't mind paying a higher multiple today, 25 to 30 times. Meaning to say you're paying $1 and your break-even period is 30 years, assuming that there's no growth. Of course, then you can bring in the discussion that, S&P companies, they're the best in the world, 10%, 15% expected growth rate in the next 5 years, whatever the analysts project. But at a 30 times PE, meaning your break-even time horizon is 30 years, and if you do a 1 divided by 30, that's a yield of 3.33%. And considering that the long-term yield today is at like 5%, 4 plus, 5%, very hard to justify that kind of equities risk premium and what you are looking out forward.
US forward PE is only about 21.5 forward PE. I'm looking at forward PE lah. The one that you quoted maybe is trailing PE. It could be different. So forward PE means you are taking the price divided by the expected earnings over the next 12 months. I think this is a better metrics as compared to just looking at trailing PE. The reason is because sometimes market ran up first, not because of their historical earnings is good, right? It's because analysts knows that now all the earnings are looking good, growth are looking good. So earnings over the next 12 months, which I think they can predict quite well. So for S&P 500, I think you are looking at this red line here. So it's about 21.5 as of October. So this is fairly updated numbers. The more interesting part is actually the dotted pink color here. This is showing the mega cap 8. Basically, it's a Magnificent 7 plus Netflix. So the name of the companies are listed here. So they are definitely more expensive. Actually, they are the one that push up the total market cap of US. It's mega cap, right? The growth is also higher, especially for companies like Nvidia, right? So I would say that that's why they command a much larger PE multiple. I just want to quickly also mention about the Shiller PE, which I think also mentioned many times, okay? Because the Shiller PE, I think the good thing about it is because it is more stable. So you are not just looking at 1 year earnings, because if you look at single company or you look at even S&P 500, if you just focus on 1 year numbers, right, 1 year earnings, forward PE, trailing PE, doesn't matter. The earnings itself, right, is very volatile because sometimes the entire economy is in recession, right? So if you look at one number, it's very volatile. But if you look at 10 years period, right, past 10 years earnings, and you take an average and then you adjust with the inflation, right? That's how you come up with the Shiller PE. That one is like arguably a more stable number because it is not affected by volatility in the earnings. Okay, that's why people also prefer that metrics to judge whether market is expensive or not. The problem with Shiller PE is that the earnings, right? You need to remember right now. Let's say we are now in 2024, right? When you look at the past 10 years earning, you are basically looking at the earnings from 2014 until 2024. So remember, 2014 is still not too far away from the global financial crisis, because financial crisis hit around 2009, and then even 2012, I think the entire economy was still quite weak, and then only from 13, 14, 15, 16 onwards, right, it start to pick up, and the real pickup actually came in the period between 2015 to 2023. Those period, of course, in between we have COVID, we have a lot of stuff happening, right? But the important thing to mention here is that the earnings as you look at the earnings, it started up from a quite a relatively low base, right? And then you just average out, right? Because you are capturing the earnings, which is very low from 2014 until let's call it like 2017, right? So you pick up those low earnings, and then when you pick up those low earnings, you take today's price and do a division, right? Actually, it also makes the metrics looks high. Even the inventor of Shiller PE, which is Dr. Shiller himself, right? He also say that this metrics is not a good metrics because on Shiller PE, it looks like we are at historical high valuation, but actually it is not. But it is not cheap either. It is okay-ish, slightly on the high side, but it's not as high as what is being implied by the Shiller PE chart. If you look at the chart.
Before I let Eric comment, right? Maybe Bunty want to share again. I was looking at the exact same document. I think you didn't do justice to the graph because it's very messy. I strip out everything, only showing the forward PE ratio, which is the one denoted in blue. So you told me that just now was 22 times, right? Then here lah, it shows 22 times. So when we really look back, actually other than the 2021 post-COVID recovery and the dot-com, we have never been higher at the current pricing now, at current points. Do you think that we will revert back down to the mean, or do you think that there is the mean? Or
Revert to the mean got two ways. One is really the price contract, then you come back to the mean. The other way is just for the earnings to continue to go up. And then if the earnings go up, this line, even let's say price remain stable, right? You will get something that's lower. And go back to your initial argument, right? You take 1 divided by, let's say 22, right? I can't do, I mean, it's probably about 4.5%,
Yes.
right? So 4.5%, that's assuming your earnings remain unchanged, constant earnings, you are getting 4.5% yield. And let's say if you are able to squeeze, let's say 3% in earning yield per year, right? From 4.5, you get 7.5%. If you've asked me, 7.5% is lower than historical earnings or historical returns from stock market, but it is still higher as compared to, let's say, bond yield, right? Bond returns. So that's why I'll say we probably get something between, let's say, between 5 to 8%. That will be my expectations at today's valuations. So I'm not saying that it is cheap. I'm just saying that it is probably not as high as what being shown on the chart here. Because the earnings as of today might be different as compared to earnings some, let's say, 10 years ago, 15 years ago.
I mean, I'm here to play the part of the bears lah. But anyway, to still man my own argument, right? The quality of earnings, that one is important, because if you're to compare back to the dot-com and today, I think profit margins of the entire S&P actually grew by 60 to 80%. So last time, I think we were closer to 8% net profit margin. Right now, we are closer to 14, 15%. So I think that probably also explains so-called the quality of the earnings, which means that if we almost double in terms of earnings, bottom line earnings, even if valuations double, we are at the same.
No, actually, I'm quite curious so let's say S&P is overvalued lah. Let's say Bunty is wrong after his whole 1 hour lecture. My question would be like, what are the other alternatives that you can invest in?
The question is thrown to me, is it?
Asking Chikeng?
Maybe it's to me also. I'm also wondering myself.
I don't know. Maybe I just share with you my thoughts on this question, right? Like what's my conclusion that I get? Because S&P now is so touted as the Goldilocks, right? Like nobody can beat it. Right? It's the best thing. It's the next best thing after sliced bread. So they have been talking about this for the last 10 years because of the S&P significant, tremendous rally for like 12, 13, whatever percentage that you want to quote over the last 20, 30 years, right? And because of so much of these expectations and fund being flowing into it, right? Actually, that's where the worry is. I'm not as worried when people say, "You're investing in a scam. Don't waste your time. It's a crazy machine that eats people's monies up." I think means when there's a healthy level of skepticism, means expectations might not be expected. I'm not talking about China market or Singapore index. That doesn't. It's not the point. Like the main point is really when everybody is saying that that's the next best thing, right? Usually it wouldn't end up well, at least in the next 10 years or so, because that it's just a herds mentality lah. And the markets are usually, because of this pricing mechanism and expectations being built in, that's my biggest worry. But I think for a lot of people later, right, that comes in and buy, right, and then they don't have a long time horizon, and then they get bluffed into it saying that, oh, Kelvin tell me S&P confirm make money. Then 10 years later, just nice my retirement hit, I want to fire already. Hey, how come like that? How come suddenly lost decade? I don't know what. Yeah, my projected 8-10% where's yeah. Then jialat already. I think that's my bigger concern. Not so much on how to do this whole thing.
Then they can leave the comments on Kelvin's channel, and then they will sleep well.
Yeah. But actually, the S&P 500, right? I think maybe among us, right? I mean, like including for us and plus the content creator, influencers, right? Maybe S&P 500 is like the golden, like strategy, the best one. But actually, if you ask around, this one, maybe the viewers, right? Maybe you all can also help to survey a bit, right? So just ask around, ask your friend, your closest, like 3 of your closest friends, just ask, do you invest in S&P 500? Just ask that questions, right? Or say, let's say among the general public, I'm not talking about influencers, I'm talking about like people on the street, right? Because you may be someone who is interested with all the financial topics, you watch this channel, maybe you are not a good, um, subject or person that we should survey. We are asking you to ask the persons that you are close with, ask your spouse, ask your friends, like, do you invest in S&P 500? Just ask that questions. My guess is that, right, probably less than 1/3 of people actually invest in S&P 500. That's my guess, because most people still don't put their money in stock market.
Actually, no need to ask around because the OCBC Financial Wellness Index 2023 has this data. So basically, they go and ask what the investors invest in over the past year. So the biggest percentage is 38% in fixed income securities, bonds, basically SSB. It's not mutually exclusive, so they can be investing in bonds and stuff. Then 36% are investing in local shares. The surprising thing is people who are investing in local shares, there are bigger allocation, 36% in local shares as compared to 26% in international shares. So for this case, Funti is right. So more people are more bullish, not more bullish. Maybe that's their starting point and they stick with it in Singapore stocks as compared to overseas stock.
My simple pushback is the Singapore market is too small. The survey market is also wrong because you're talking to 5 million people when I'm really looking at it from a global scale, and especially if influencers, right? Because their reach is crazy. We talk about Calvin having 100K, but US influencers have 5 million, 10 million on TikTok. And all they're talking about is S&P. I mean, those more prudent ones are talking about S&P. We're not talking about like crypto projects that they shield the next 1000x or something. So that was where my place of concern comes from. But yeah, I agree that even people around me, they're not into S&P. But I don't think Singapore is an indicative market anyway to begin with. Like Eric haven't comment yet, so S&P still can buy. Bao jia, is it can what until xiao?
But I don't have anything to add. Like after Bunti's lecture,
Do you think S&P will crash?
of course it will crash. So actually, just now I was listening to Chiking, right? I think I wanted to ask Chiking if because you are young, right? That's why you're not willing to buy S&P. Because you have a lot of time in the world to wait for a crash, right?
Rubbish.
I wanted to ask you that.
I've never subscribed to that mentality.
You never subscribe to the.
I have. Who said I don't have S&P 500? I have. It's not a very big portion. Actually, no, I'm quite invested there in the markets. Meaning every time I did share before also, right? That my theory is this. It's a bit unconventional. It's not the traditional advice that you put S&P, that you put emergency fund, then keep war chest money, that kind of thing. Because I look at it as this is your lifetime income. And for those that just started out, you are here. Meaning you still have such a long time period. So for those people that thinking that I want to buy cheap, means in between you keep holding cash, right? But then you'll miss out the compounding period, right? In theory. So you're lucky if you start working in 2019 and then you 2020 hit COVID crash, 2022 hit the inflation bear market, then you're very lucky. What if you graduate into 2009? Then you hold cash for 20 years, is it? Then you wait until the 2020 crash, then you put all one shot, the money all go in. But then you realize that actually the market really run up a few 100% already. So that's why I think that actually there's a research that done. It says that lump sum investing is definitely better than dollar cost averaging. That's if you already have the money. Because the idea is the market is usually up more times than it's down. I think the stats is around 75 to 80%. Every year you refresh or you press restart, right? 75-78% of the time the market is up. So it's always good to buy because more often to be up than down now. So the logic is shouldn't be you should keep holding cash, then you buy when it's down. That's if you're talking about index approach lah. But of course, I'm not in the index approach style. I'm in the security selection style. So you just time it opportunistically lah. But I don't hold very big amounts of cash. Maximum 10-15%. I don't know whether you call it big or not lah. But to me, I don't think it's compared to people that I see nowadays. They can hold 20-30-40% no problem. Then I'm like, wow, if your portfolio is let's say few 100,000, hold 20-30%, that's at least 6 digits on the side. I don't know what they're doing lah. If hopefully it's in like UOB or something lah. But if it's like really stay in the brokerage account and not giving you interest or not in money market fund, I think that's quite a big opportunity cost just because you want to try to time the market though.
You sound smart when you pretend to be a bear lah. I think bear always give people impressions that the person is very smart, is very thoughtful about like market. And then those perma bull, right? People will say that perma bull clueless one, don't know how to read basic chart. So that's the thing. But actually the one that is getting rich, right, is the perma bull. So that is a fact, yeah.
So it's better to be rich than to be smart.
Yeah, better to keep on stay investor, do your DCA on S&P 500, do this for 10-20 years. But on channel, we need to be bear already. You need to tell people market is going to crash in 79 days.
Bunty is smart and rich. KCL, but he behind also don't buy S&P, everything buy Nvidia. You see, hot until.
You know why Eric is smiling? He's like S&P 20% 20% return. Pui.
So you know because I've been quite bullish on China for quite some time already. Then I don't block people lah. As in I let those commenters that even say very nasty things, I let them comment. So back then I do a portfolio review from time to time. Then a lot of people was like, so the whole overall portfolio was negative. So it was like down, I don't know, 15% or something. Then I invested for quite some time, like 3 years plus. Then I still remember this comment that I don't know why he stay rent free in my mind. He was saying, "Why you so stupid? All in ordinary account lah, CPF. You put 3 years, right? At least got 6%, brother. Why you spend so much time think here, think there? Just all contribute ordinary voluntary contribution lah, 6%." Then I'm like, okay, as in I note his point. Maybe he really has good intentions, but if I really back then I just keep thinking about switching strategies. People tell me options trading is good, momentum trading is good, or like I listen Kelvin say, "Oh, wheeling is the best, can make free money from Tesla." Then I go and do that, right? You don't see through the whole process, right? Then you'll miss the whole run up there.
That's why all this DCA and just keep DCA. All this sounds very simple, but actually not easy one. You need to do it and then you need to see it works. And you need to see it works, right? You cannot see it works in 3 months time one, because 3 months, 6 months, 1 year, even 2 years, right? You will see the up and down one. You will lose money. You do it for 2 or 3 years. One bear market come, then you down, re-rate already. So you have to see the compound effect kicks in, and that one I would say usually at least 5 years. So how to just DCA continuously do that for 5 years, right, and not being affected by all these people's, right? That one I would say you just need to grind through that kind of period to see the compounding. It's very important to see that, because once that compounding start to kick in, right, and then you see you think that this works, right, then you don't have to you won't be affected already, because you have seen it works, right? Then people keep on telling you, you should trade in and out, you should do this and that. You're just like sitting there doing nothing, just continue to DCA, and then you are the one that blur still, after 10-15 years become the rich one. You also don't know how, because you have adopted the right strategy. But not everyone is successful, because there will be people who, bear market come, they panic already, they went up. Let's say you do that for 3.5 years and then you panic sell, right? That feedback loops is not complete. You haven't seen it work. So that habit is not embedded into your overall strategy. You haven't internalized it, right? Then it's like wasted already. You need to try again, maybe another 3.5 years. And then if you panic sell once, right? Next time when there's bear market, then you panic sell again. So you're continuously in that kind of bad cycle. So that's quite bad. So that's why I would say is regardless of market valuation, it's good to continue to do that. Just push through that 5 years or so. That one is very important. I would say many people they wasted not wasted money, they wasted time.
But the DCA I heard before is you need to DCA at least into a market that is rising.
Yeah. No, you DCA into index, broad market index. Even it is down, you also do that. It will works one. You need period of, let's say, more than 5 years.
Like Japan.
If you are unlucky, if you are not
Japan
Japan,
also went
we're
all-time
talking about
high.
S&P 500, ma. Where got
No,
Japan S&P?
but even on that point, right? A lot of people they like to bring in this kind of argument, right? Japan lah, Hang Seng lah, China. You know, as in if you pull it out long enough, right? It's
Yeah.
still up, leh. As in it's not even if it's at its lows, right? Like you bought and you keep buying, you will still be up. Maybe the IRR or the CAGR might not be your 10, 12%, but it's still positive compared to realizing the loss or just going down and saying that your investing is rubbish. Yeah.
So you're talking about like 20 years time horizon.
You don't need 20 years. I would say you need between 5 to 10 years to see the compounding effect. And you don't need to do like you don't need to all in your saving. You just need to all in a constant amount. Say for example, you have saving of 1,000, right? You think 1,000 expensive, don't do 1,000. You just do 300. Just 300 every month. Just the consistency is more important than the amount. Like the 300, even if it compounds or even market crash or whatever, it's not such a big impact given that you're putting in, let's say, like 3.6K per year, right? It's not going to be big, but at least you can, once you see that compounding kick in, I think that's a lot more important. Like this is all about the habit, setting your habit, and not about like getting your first 500K. The habit is more important because once you have the right habit, right? Once you see it works, right, and then you continue to build on that, right? The compounding will come later, and the longer you do this, right, the effect is greater. So that's why watch all these news about market crash. For entertainment is good, but for the real strategy, the real things, right, the long term compounding strategy, right, is still the consistency is still the most important.
Sorry, to substantiate my point, right? I just went to pull out Hang Seng 10x in 37 years. So it's a 6.4% CAGR. Regardless of how bad or how trash they tell you China is, still got 6% CAGR. That is if you invested like in 87, 1987. But
do you have like STI?
STI, even if it even STI all-time high now, by the way. As in, it's near 3,000 that global financial times. And then but you don't forget got the 3-4% dividend yield. So your CAGR is at least 3-4%.
3-4%?
Yeah. So it's probably better than the guy that says CPF OA lah. I mean, to prove a point, I'm really being very, very cock here. Yeah lah. So anything that you take some sort of equity kind of premium, right? It will give you more than 2.5. If not, how in what world would CPF promise you a higher return? Like why are they giving you that baseline return? So I'm just saying, but of course it needs to go through a very long time horizon to compound. Might not be the fastest, but we're not talking about whether it's fast or not, but whether there is some sort of a source for returns or not. That's the bigger point.
So anyway, just to add two last point, right? When you all say the people who are very bearish, they are very smart. I think it's also because of fear. Like they see the market up so much, right? They're also scared, but they need to say something so that the people don't expose them lah. Like, hey, you are just scared, you don't dare to invest and all that. So I said, no lah, I'm smart lah. I know how to read charts lah. I wait for a better time lah. But the thing is the execution, right, of buying when the thing plunge, right? It takes a lot of mental fortitude, and I really don't know that many people who are that strong mentally. When the stock market crash like 30-40%, and you're still like, wow, whack lah, bro, let's do it, man. I really the last time I hurt myself was during the COVID times. I was just telling my wife, yeah, very scared. Like, yeah, it's really not easy. But yeah, there will be people who will say it's very easy. Just wait for the you know. But every time there's a 20-30% crash, that must be like a really serious situation, right? For it to crash so much. Yeah. So that was the thing I was trying to talk about.
Not too sure where this video will land and whether it's too dry for you guys. We'll try to do some magic in the editing and to make it a more succinct discussion. But hope you guys enjoyed it. Try to remain cordial in the comment section, and you can fight for your case on whether you think it's still a good time to buy or a time to be a bear. So with that, we'll see you guys in the next video. Goodbye.